X Money, I don't know if you've heard of this, it's just released at the end of June to premium Twitter or X subscribers. They're calling it the bank killer. Is it worth the hype? How does it work and what do you need to watch out for? I've got that and more coming up. Guys, we might be seeing a colossal, monumental shift when it comes to how you bank, right? How you bank. And things have shifted. I'm going to say 15 years ago, maybe 20 years ago, there was always this traditional banking. You would walk into your bricks and mortar bank. There's the teller there. Maybe there's the menu, the sandwich board right when you walk in that shows the rates, what our CD's paying, what our money market's paying. And by the way, it was pretty awful. But yeah, like 15 years ago, maybe 20 years ago, online money markets were introduced, and online banking, not just, an online way of dealing with your bricks and mortar bank, but actually like online money markets that paid a higher interest rate, more competitive interest rate, and things have sort of stayed like that for the past 15 years or so. Still that bricks and mortar bank, and that's maybe comfortable for a lot of people, but then online banking where you can take a more intentional approach to get more interest earned on your money markets. And guys, we might be adding a third layer to that, or at least taking that second layer, that online banking, and moving it up to a level that many people, it concerns a lot of people, but it might be setting a new standard. What I'm talking about is X Money, and so X, formerly known as Twitter, X Money. Not sure if you heard about it. It's been around for now just a couple of weeks, and it's almost, guys, too good to be true. So what are the features? How does it work? And what do you need to look out for? So X Money brings digital banking right into your X, formerly known as Twitter, right into that account. It's not a separate app. It's not something that works like in isolation or separately from Twitter. It's sort of bundled in, right? And you can send money directly by adding someone like at their Twitter handle or X handle, and you send them dollars from there. Behind the scenes, there's a multi-layered banking strategy within, and then there's credit card features as well. It's pretty next level. The eye-popping item that is catching a lot of people's attention is they are offering a 6% return on your dollars. That's right, 6%. And there's no gimmicks where you gotta, if you gotta have 13 deposits and eight debit transactions or whatever. There aren't any conditions to that. It's 6% on a seemingly unlimited amount of your deposits. That is unbelievable. And again, makes it feel a little like, hey, is this too good to be true? They do that by from your X account, they've got a multi-bank kind of layering system where they're allocating dollars to different banks that are agreeing to pay, high level and very, very high interest. So 6% on all cash deposited within X Money. And here's the other one, $10 million in aggregate FDIC insurance, again, through that multi-bank sweeping program. Also, unlimited 3% cash back on eligible purchases with, some exclusions, of course. You got a pretty sweet card. I haven't seen it yet. I've seen some pictures of it. You got a pretty sweet Visa card as well. And then a whole host of other features, including free ATM usage and ATM withdrawals or reimbursement of some of those fees. So guys, I think with that laundry list of features, I think the hype about, could this be the bank killer? It very well could be. We might be drawing a line in the sand and saying there's a new way of banking and this is the way you do it now moving forward. Now, with those eye-popping features, almost like, again, you got to try to figure it out if you're tech savvy and you got to see maybe this is the way. 6%, hard to turn down. There's a few just risks that I would want to point out and want you to be aware of. And of course, as we learn more and as this gets more traction, we'll talk about others. But 3 risks that you need to be aware of. First, the obvious one. Can the 6% yield last? Can it actually last? When you have the Fed keeping the Fed funds rate, just north of 3%, you've got most online money markets, or they also are called high yield money markets, but high obviously is a relative term. If X Money is paying 6%, those high yield money markets are paying 3.5. Some of them may be getting close to 4. So really, is that 6% by X Money, is it sustainable? Well, if you peer under the hood, the money's got to come from somewhere. And if Treasury's only paying 3.5%, if you buy a long Treasury, which you really shouldn't for bank accounts, these banks, if you're buying long Treasuries, maybe you're getting 4%, something like that. And so if everyone else is paying 3.5%, 4%, and therefore your deposits, that's what they're earning by X money in these banks, they're then paying you 6%. That money's got to come from somewhere. And the question is this 6% more of a promotional rate, trying to get this thing off the ground and get you using their network and their system? Or is it sustainable? My hunch is it's not sustainable. It's not going to be 6% ongoing, and I wouldn't expect it to increase. I would expect it to decline. And yet I also expect, just with the other features, that they are going to be setting the standard and will be paying a very high rate or a above the norm rate for these high yield savings account. And even when they, and we don't know when, but even when they'd have to back off of that 6% yield. That's risk number one. Second, risk number two is really more of a complication type risk. This multi-banking sort of layering system, this is not actually new, okay? It's been around for several years, and it creates some complexities, okay? This multi-banking strategy is essentially where you log in and you have an interface, okay? An interface where you deposit your cash reserves. And then that interface is really a network where they put $250,000 here, which is the FDIC limit, and they're paying a high interest, and then another 250 to this bank, another 250 to this bank, another 250 to this bank, and they spread it around, and that's what allows you to get that FDIC protection much higher when you look at aggregate, because you're using these other banks sort of in the background. Well, that can create some complexities. One, if your address changes or contact information changes, I'm assuming X Money has that all figured out, where you would just go to X Money and they would update it at all of these other institutions. But what if one of those institutions really fits the X Money screens on day one, but a year later, that bank no longer is paying high interest or no longer wants to be a part of that? There's a lot of moving pieces behind the scenes. Are you getting notified if those sorts of things happen? Or is the network set up and ecosystem set up where X Money can just handle all of that, creating no complexity to you? Further complexity is what happens if one of those banks comes under duress, right? And you might say right now, oh, that would never happen. Guys, it just happened a few years ago. It just happened a few years before that. Like, yes, it's very unusual and very rare, but can happen. And so if one of those banks comes under duress, you don't even know that some of your dollars are at those banks because they're through X Money. And then lastly, these 1099s, right? If you're getting a 6% return, you're getting a high yield on your cash, and therefore you're going to get some tax documents because of that. And I say documents, we don't know yet. Are all of these different kind of multi-bank, all those 1099s going to roll up to one from X Money? I don't believe that's how it would work, although I don't know. Elon Musk is obviously smarter than I am, and maybe has figured this out, and the individual he's tasked to lead this charge, maybe they've figured this out. But typically, you're going to get 1099s from all of these different banks, and you don't know, well, did I get all of them, right? And I have got 5 of them. Should I have 6? Should I have 10? Like, I don't know. And that, again, adds some complexity. And then the final risk is another obvious one, and that's the financial security, right? So through X or through Twitter, obviously with social media, there's got to be some protections, so login and all of that, and hacking. I mean, that's got to be sophisticated. But then bank level sort of protections, that's at a different level, right? Then I would say even social media. And so therefore there's definitely some risk there with, well, if your financial resources are connected in this very popular social media platform, and will they have the right security protocols in place to protect your identity, protect your login information, and do multi-factor authentication, all those sorts of things. Again, I'm not saying it's not robust right now. I'm just saying when you add banking to it, will they add the extra layers of notification, extra security layers, so that it would be deemed a safe place to have your resources? Is it worth the hype? I think so. How does it work? I just explained it. 6% on a yield is pretty incredible. Watch out for those warnings as well, those negatives, and be aware as well. For me, definitely taking a close look at this. X Money, check it out. Work with your certified financial planner on really the approach that you should be taking with your cash reserves, not having it just be a default decision. Well, I've just banked at this place forever. No. Being intentional and getting a high return on your cash. Maybe X money should be a part of that. Work with your CFP on that. If you don't have a CFP on your team, you can contact one on my team. Find us online, Korhorn.com. That's Korhorn with K. WiseMoneyShow.com. You can find us there as well, or give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.